So very good afternoon to all. The most respected past president of ICAI and today's session chairman, CA Manoj Fantin sir. The faculty of today's session, CA Gururaj Acharya sir. The leader of the profession from Kerala, the Central Council member, CA Babu Abraham Kalluvalil sir. The immediate past chairman of SIRC of ICAI, CA Jomon K. George sir. The chairman of all Kerala branches of ICAI, MC members of all Kerala branches, illustrious past chairman, my dear beloved members of the profession, and ladies and gentlemen. Today is the third day of this unique conference named Navaratna, organized jointly by 9 all Kerala branches of ICAI under the shelter of 2 strong pillars of ICAI from Kerala, CA Babu Abraham Kalluvalil sir and CA Jomon K. George sir. I feel that this is the first in the history of Kerala and maybe first in the history of ICAI where all the branches of the state are united to share their thoughts and knowledge under a single platform. And the conference is absolutely with the 9 Ratnas or gems in all sense. That is 9 branches, 9 days, 9 eminent personalities and leaders of our profession as chairman of the session, and 9 world-class professionals as faculties. The unique feature of this conference with this powerful 9 is that each branch will host each day's program, and today the Kannur branch is very lucky to get this great opportunity, that too on a day where the immediate past chairman of SIRC, CA Jomon K. George sir, created a history in the last year on the same day, that is on November 18th, through the historic SIRC conference, that too at Cochin in Kerala. Today on this special day, we all are delighted and honored by getting a very special guest with us, the past president of ICAI, the vibrant leader of the profession, CA Manoj Fantin sir, who was the president of ICAI during the period 2015-16. His vision and passion raised our profession into great heights. Dear sir, with utmost pleasure, happiness and respect, I am taking this opportunity to welcome you to this Navaratna conference hosted by all Kerala branches of ICAI. Welcome sir, welcome. CA Gururaj Acharya sir, a passionate teacher with excellent academic background and records, who secured ranks in all levels of his professional examination apart from the first rank in graduation level. He is a very good friend of all chartered account and especially chartered accounts in Kerala, and is a seasoned faculty. Today, all we are eagerly waiting to enrich our knowledge on the topic audit of and exemption for private limited companies through this very simple, humble and dedicated professional hailing from the Temple City, Udupi. Dear sir, with utmost respect and happiness, I am taking this opportunity to welcome you to this Navaratna conference. Dear friends, I have already mentioned that our Babu sir, the one and only Central Council member from Kerala, and Jomon sir, the immediate past chairman of SIRC of ICAI, are the strong pillars and face of chartered accountancy profession from Kerala. Without these 2 passionate and vibrant leaders, we could never imagine a conference like this. I am taking this opportunity to welcome our beloved Babu sir and Jomon sir to this Navaratna conference. Welcome sir, welcome. All the chairmen of Kerala branches are real gems of this conference and our profession. I take this opportunity to welcome all of you to this conference. I am also taking this opportunity to welcome MC members of all Kerala branches, all the past chairmen of all branches, and all my participants and beloved members of the profession. Wishing all of you a knowledge-packed, powerful session, and thanking you. Thank you very much. Thank you all. Now, before moving on to this session, I request the conference chairman, the Central Council member, our own CA Babu sir, for a few words. Babu sir.
Welcome to my honorable past president of the institute and my good friend CA Manoj Fantin, an eminent expert, not only on corporate law matters, on most of the professional matters, and he has been a great source of support for the institute in various technical committees where he has been doing an yeoman service. CA Gururaj Acharya, my colleague in the Regional Council, Jomon, Chairman of all 9 branches, and other office bearers, and my dear members. I think today we are going to discuss on a very important topic, which I am sure if any one of us are doing an audit of a private limited company, is required to be part of this. I wish this today a great learning, and I'm sure Manoj Fantasy also will add value to this conference. Once again, welcome to all of you. Thank you.
Thank you, Babu sir. Babu sir, thank you for your positive words and inspiration. Joman sir, few words from you also, please.
I'll be very brief. I would only thank Manoj Fatni sir and Guraj Acharya sir. I always say he is a guru, his Raja is Acharya, and he has been disseminating so much of knowledge. And Manoj Fatni sir is a patron, is a mentor for all of us. I had the good fortune of traveling with him across Kerala, and of course had interaction with the next generation also, generation 2, his daughter also, when I came to Cochin. So she is actively in the profession now. So nice to have you, sir. We would have really loved to have you physically here, but due to constraints, we're looking forward to hearing from you and to a wonderful session from Guraji. And thank you, everyone. Thank you, Babu sir, for making this event happen. So wish the conference all the success it so richly deserves. Thank you so much. Back to you.
Okay. Thank you, Joman sir. Thank you very much. Now I request the Vice Chairman of Kannur branch, CA PJ Riji, to formally introduce the Chairman of the session, CA Manoj Fatni sir, to the August gathering. Please, Riji.
Most respected past president of ICAI and Chairman for the 3rd day of our 9 days virtual CPE conference, CA Manoj Fatni sir. Now the speaker for the day, CA Gururaj Acharya sir from the Knowledge City of Bengaluru. The one and only Central Council member from the state of Kerala, our beloved Babu Abraham Kalivalil sir, immediate past chairman and member of SIRC of ICAI, my elder brother in profession, CA Jomon Kejor sir, all the illustrious chairman and managing committee members of the 9 branches of ICAI from the state of Kerala, and my esteemed members in the profession. A very good afternoon to all of you. It's my sincere belief that CM Manoj Fatni sir requires no introduction to the members of our profession. But as a matter of professional courtesy, let me have the privilege to introduce you a very outstanding and eminent personality, CM Manoj Fatni sir. CM Manoj Fatni is the immediate president of the Confederation of Asian and Pacific Accountants, a regional international organization of 32 professional institutes from 23 countries from Asia and Pacific region. He was elected as the president of the Institute of Chartered Accountants of India, New Delhi for the year 2015-16, and as the vice president of the ICAI for the year 2014-15. As president, he was the chairman of all the standing committees, disciplinary committee, and the board of discipline of the ICAI. He was also the non-executive director of IRDA and member of the National Direct Taxes Advisory Committee. During the current year, he is a member of the International Affairs Committee of the ICAI. He was also nominated as a member of the Small and Medium Practitioners Committee of the International Federation of Accountants for the term January 2016 to December 2018. Presently, he is an independent director on the board of the Federal Bank Limited and serves as the chairman of the audit committee. He is also on the board of the other listed and non-listed companies. He is nominated as a member of the standing committee on accounting issues constituted by IRDA. He was also the member of the group constituted by ASB of the ICAI to formulate the Indian accounting standard converged with IFRS 17 insurance contracts. He was also a member of the company law committee set up by the Ministry of Corporate Affairs in 2015 for the amendments required to the Companies Act 2013. Based on the report submitted by the committee, the Companies Amendment Act 2017 has been passed. He holds a diploma in information system audit. He has specialized in corporate accounting and reporting standards, direct taxes, corporate laws, and foreign exchange management act. He has results in technical purpose in various seminars and conferences within India and internationally. Dear members, the above is just a small gist of some of the achievements in his glorious career, and we are very much grateful to CM Manoj Fatni sir for sharing his precious time for this conference. Thank you very much, sir.
Thank you, Reggie, for your nice introduction. And now I request the icon of our profession, the past president of ICAI, CA Manoj Fatni sir, for your introductory remark and to address the participants. Sir, please.
Good afternoon to all. It's a great pleasure to join this webinar being organized by the 9 branches of Kerala. Distinguished chairman of all the 9 branches, managing committee members, my esteemed council colleague, my former colleague in the Central Council, a very dynamic person, Babu Abraham Kaluwalia, the immediate past chairman of the Regional Council, Joman George, and all my dear professional colleagues. It's a great pleasure to join this webinar, and I must compliment all the 9 Kerala branches for coming together and discussing on 9 days different topics and inviting such eminent faculties as we have today. Friends, COVID has taught us a lot of things, and one of the things which we have learned is how to use this technology. I must compliment our Central Council, our Honorable President, our Council Member Babu, and all other Council members for innovating and using the technology to the hilt so that even in this COVID period, we can be well connected with each other and we can disseminate and learn from each other and use CPE through this technological means. Friends, as was mentioned, I'm now associated with a bank in Kerala, and I was looking forward to visiting other branches in Kerala. So I've been missing that in the last 8 to 9 months since this COVID has started. And in fact, I joined the bank just before that. So this conference in a way compensates for not meeting physically, and I am therefore very excited to be part of this webinar. Friends, the topic for today's discussion is very relevant: audit of private limited companies. This is the time, given the extensions which have taken place, that most of us would be busy with the audits, finalizing the tax audits, the company audits, and in the next 1.5 hours or so, we'll be diving deep into the technical aspects, and the learned faculty would take us through the various important aspects. What I would like to emphasize at the beginning is the fact that audit is audit is audit. There is nothing like a big audit or a small audit. Every audit is an audit. Once an audit opinion is issued, it is issued. It doesn't matter if it is of a large listed company or it is an educational institution or a charitable institution or a smaller private limited company. The responsibilities that we have as an auditor are the same insofar as our audit opinion is concerned. The level of efforts required, the level of documentation required is of course dependent on the type and complexity of the audit. But the auditing standards are what is important for us to be following to ensure that we follow the relevant auditing standards. In fact, people like Babu and myself who have passed many years ago, and there are many of us who would have passed, I would say, in the 20th, before the turn of the century. Friends, the entire concept of audit has changed since the time many of us have qualified. Those who have qualified in last 10 years are actually have studied the today's relevant standards on auditing in greater depth. Today, the concept of audit has changed and it has moved away from the transactional audit that we used to carry out. Today, the emphasis is on risk assessment. The starting point for the audit is SA 315. And these are the important things which we should bear in mind. Because when we issue an audit opinion, when we issue the audit report, we say that we have carried out the audit as per the generally accepted auditing principles in India. The generally accepted auditing principles in India are none other than the applicable auditing standards. So it is SA 315, SA 240. SA 240 is very important in terms of what is our responsibility for frauds. We are not there to detect a fraud, but we have a responsibility to consider whether there is a fraud in the financial statements and how we have geared up us and our audit team. What is the requirements in SA 240 So these are very important aspects. So when a question comes whether the audit has been conducted properly or not, the institute's disciplinary committee looks into the applicable auditing standards, looks into the applicable documentation which is expected from the auditor, and then evaluates how we have done it. So let us look at today's session in terms of learning what we are supposed to be doing, what most of us are always doing, but it is always better to look at things afresh and see wherever there are gaps, we add up and we fill up those gaps. So whether it is inventory verification, valuation of inventories, verification of fixed assets, these are very important aspects even in context of smaller private limited companies. Take for example, the areas in case of private limited companies which generally get overlooked, provision for bad and doubtful debts. Because it is not tax deductible, many companies do not make a provision for bad and doubtful debts. It is not sufficient for us to have a note in the financial statements to state that the current assets have a value in the opinion of the management which is equal to their stated values. It is important for us to carry out audit procedures, document those audit procedures, and see that we have issued an audit opinion which is in accordance with the applicable auditing standards. Friends, there is a very good guide issued by the Auditing and Assurance Standard Boards, that is, Guide for Audit of Smaller Entities. It is available on the Institute's website, and I've been using that and I've been advocating that in all my seminars, because at one place it gives us what is the complex documentation which is required to be carried out. And that complexity is explained in simple and easier terms, and with the help of charts and with the help of tables, so that we can actually borrow those templates and use them for our documentation. So I'm very happy to be part of this webinar, and I'll keep connected as we move around in this session. Towards the end of the session, I'm sure there will be questions which we can all discuss upon and share our knowledge. I'm very happy to be part of this seminar. Thank you so much.
Jayaprakash, thank you very much, Manoj sir. Will you be staying through the session? Do you have the time?
Positive thoughts and advices will be sweet memories of this Navaratna conference, and each of us will carry the same till the end of our professional life. Now, I'm sure that all are eagerly waiting to hear from our own Guru, CA Gururaj Acharya sir. And before that, I'm requesting the treasurer of Kannur branch, CA Dinesh K. Kumar sir, to formally introduce the faculty of this session. Over to Dinesh sir.
Thank you, Chairman. Chairman of today's program and beloved past president of ICAI, C. Manoj Fandi sir, immediate past chairman of SIRC, CA Jomon Kachar sir, Central Council member Babu Abraham Kalivai sir, renowned speaker of the day, CA Gururaj Acharya sir, distinguished guests, colleagues, senior members in the profession. It is my pleasure and privilege to present before you a great personality, a talented teacher, passionate teacher, a guide and guide of the profession, ever smiling, CA Gururaj Acharya sir from Bangalore. He is a chartered accountant and also a qualified cost accountant. He hails from the temple town Udupi. Brought up in the iron city of Bellary for joining CA archbishop under Messrs. Guru Prasad and Company, and now settled in the knowledge city Bangalore. He ever be a very brilliant student, and his academic achievement includes first rank holder of degree of commerce in law from Gulbarga University, first rank holder from CA India, 10th rank holder of CA final exam, and first rank holders in ICAI India, and third rank in ICAI final exam. He is a member of the Bangalore Financial Reporting Review Group, formerly under the FRR Board of ICAI New Delhi. Was a director of State Bank of Mysore. Was a member of the Karnataka State Level Audit Advisory Body. Was also the member of the Expert Advisory Committee and the Committee on Accounting Standard for Local Bodies by ICAI New Delhi. He authored a book titled Indian Financial Control, Practical Handbook on Audit Report. What Can Be Wrong? Published by Karnataka State Chartered Accountants Association. His articles titled Company Law Updates is regularly featured in the monthly newsletter of Bangalore branch of ICAI. He is a resource person of the Institute on Accounting Standard and Audit, Companies Act 2013 and LLP, Corporate Finance and Financial Analysis, Corporate Tax and Audit. He is presently a senior partner of the Messrs. KG Ajare and Company, a chartered firm specializing in corporate finance, corporate taxes, and company law. Headquarters in Bangalore. Dear members, this is a very brief introduction of Gururaja Ajare sir. Sir, we are extremely happy to hear from you in this third day of our special program, Navaratna. Thank you, sir.
Thank you, Dinesh sir. Thank you. Now over to the faculty.
You could probably announce that the participation.
Okay, sir. Okay. Now over to the faculty. Say Gururaja Ajare sir. Sir, please.
Thank you, JP. From Kannur, I am so happy to be in all the 9 cities at one place at one time. Thanks to Jaman for providing me this wonderful opportunity. I know there is a greater God in Kerala called Babu Abraham Kailivail, who's been the silent director behind the entire program. So I thank Jaman and Babu Abraham Kailivail for giving me this wonderful opportunity of sharing my views on the topic, a very interesting topic, private limited companies, audit, and what are the exemptions available to the private limited companies under the Companies Act 2013. And I'm fully aware that I have if I am a guru, I have a greater guru in the chairman. You have chosen the right chairman for my session in the past president, Mr. Manoj Fadnis, whom I respect a lot. I'm so happy to be with him today on this program. Thank you, sir, for chairing this particular session and being with me, if possible, throughout the session. And I also thank all the 9 cities and the members of the 9 wonderful gem cities of Kerala for being with me. When we were discussing, we were told that the maximum number of panelists that can be there on this particular program, and we are all there as panelists, whom you can see on the screen, can be 15 according to this particular platform. At once it reminded me that the maximum number of directors that there can be there in a company is 15. Maybe the people who have formed this particular platform must have felt that the maximum number of, I used to say that physically in a boardroom, not more than 15 can be sitting peacefully. So the maximum number of people in a boardroom can be 15. So therefore Companies Act said 15 board members in a company is the maximum number. But then now today technology also has put in that particular ceiling. But of course in the Companies Act, the numbers can go up, the number of directors can go up through a special resolution. So what we are going to do in the next 1.5 hours or so is that I will be taking first on the exemptions that are available to the private limited companies. And in the process, I will be harping on those points which are very important for the audit of private limited companies. And then I will be taking on certain aspects of the audit aspects and accounting standards relevant to the private limited companies. And in the end, I will also put up type of one particular notice which has come to a chartered accountant, a very lengthy notice which has come to a chartered accountant, and we will see how notices can come to a chartered accountant and how all these 500 and more chartered accountants can actually be prepared for not getting such a notice, So we'll take it up on a very practical note. But in the meantime, I have told JP that in case any questions that come out, I request all the participants to be active participants. I know it is an afternoon session. All of you must have had a good meal. But then the best part for a virtual session like this is I cannot see if you are actually sleeping or lying down and listening. But then people on the panel definitely will have to be more alert. And I am definitely alert. And I'm sure JP is. So if you have any questions, you can pose it as and when, and at appropriate stations, I will ask for the questions to be posed, or JP, you can read out the questions and we can take up the questions as and when. So I will now put up my presentation particularly. JP, can you see the question, the slides, please?
Yes, sir. Yes, it's okay.
Have come together on this wonderful day, 18th November. I mean, 18 is a very good number because you add up 8 plus 1, it becomes 9. And you have 9 9 branches of Kerala, which almost every branch I have visited and addressed the members there with all passion, and it was my honor, thanks to Babu and thanks to all the leaders of Kerala who invited me there. I cherish every moment, and I remember every moment that I have spent with you. And as a very interesting point is, I'm sure that Manoj is here. Maybe for his sake, sir, Kerala in every city has got a Kerala name and an English name. Was an English name and has a present English has a name in Malayalam. So Trivandrum is Thiruvananthapuram, Cochin is Kochi. So like that, every city, Alleppey is Alappuzha. So like that, every city has an English name, probably definitely named by the Britishers. And now the people from the God's own country have named it in their own language. That is the names which I put up on the third column there. Having said that, very interestingly, I was looking into Kottayam. If I'm right, Kottayam was one place which has not changed its name from what it was to what it is. Kottayam, and maybe I was just thinking that it could be because every name which was changed was probably not the Britishers were not able to pronounce it, and hence they had to change the original name to the English name, and now with the English name it has come back to the original name. Kottayam is one place which probably they were able to pronounce it properly, and therefore they did not change, and hence there was no need for people of Kerala to change it back. Having said that, interestingly, Kottayam is one place of the 14 districts of Kerala which I got to know that is not bordering Arabian Sea. Otherwise, all the other 13 districts of Kerala shares a part of Arabian Sea. So that is one of the special features of Kottayam. I was there in Kottayam when the new building got inaugurated. I remember that was when T.N. Manoharan had inaugurated, and I was there to address the members of Kottayam. So with that brief, let me now get into my topic proper, that is private limited companies, audit of, and exemptions for them. So first of all, I'm sure all of us know what is a private limited company, but it would always be not out of the way to, for a moment, focus on what is the definition of a private limited company as per the Companies Act. Section 2, subsection 68 goes on to define private limited company as a company means a private limited company means a company having a minimum paid up capital as may be prescribed. Now they removed the word of rupees 1 lakh. Initially, every private limited company had to have a minimum paid up capital of 1 lakh, and for a public limited company 5 lakhs. So that in 2017 they deleted. That is because of getting more marks in the context of ease of doing business. When the countries were ranked for ease of doing business, this was also one of the parameters. So they felt that anything which was acting as an impediment to improve our ranking in the ease of doing business, the government went on to strike off that. So for the moment, you of course need to have a share capital, but it need not be 1 lakh. It can be with a 1 rupee also. So there is no minimum share capital prescribed through the Act, and which by its articles. So very importantly, the Articles of Association goes on to limit 3 important aspects or restrict 3 important aspects. One of them is restrict the right to transfer its shares. The shares are not freely tradable. The shares come with a restrictive right of transfer. We will see what it is. And then, except in the case of an 1-person company, limits the number of its members to 200. So the maximum number of shareholders, minimum being 2, maximum being 200, is what is told in the Companies Act, and that has to be told within the Articles of Association, reiterated again in the Articles of Association, provided that in this number of 200, very interestingly, joint holders are considered as 1 shareholder, one shareholder in that 1 member, and also very interestingly, if there is an employee, a current employee who is also a shareholder, that employee shareholders number will not be counted in 200. As also, if there was a past employee, who was a shareholder when he was in employment and today he is not anymore my employee, that past employee who was a shareholder will also be not counted within this 200 numbers. And third prohibition third prohibition in the case of a private limited company is prohibits any invitation to public to subscribe for any securities of the company. So shares cannot be allotted to the public, cannot be issued to the public at large. So these are the three important restrictions. Now, having said that, let me just talk about one very important aspect, that the restriction in the right to transfer its shares. I mean, recently we had to deal with one of the situation where one of the shareholder had to go to the police station. I mean, saying that I am holding 10% shares, and I mean, he was actually an employee shareholder. They had given him 10% shares, and then because of some issue, he had to be removed. And then he went to the police station to say that I have got 10% shares. Now I want to encash this. So please ask the company to pay my 10% shares worth to me. He went to the police station. Then we had to then at that point in time educate the director, saying, and also go to the send some of our representatives to say that this is not a matter which is to be dealt in the police station. It is not a matter, if at all, it is a matter to be dealt with in the National Company Law Tribunal. He has to approach the tribunal. But at the same time, the shares that he owns has got a restrictive right. I mean, the company cannot be forced to buy the shares back. So what are the restrictions associated with respect to transfer of shares in a private limited company is what I thought I will talk now. Cannot have total prohibition on transfer. When the articles can restrict the transfer, the right of the transfer of the shares, but the articles of association cannot say nobody can transfer anybody's share. I mean, like that, they cannot put a total ban or a total prohibition on the transfer of shares. But section 2 subsection 68, just now the definition what we saw, restriction is only through the articles of association. So if at all, I always keep telling this in my office also to the secretarial desk, that if you want to put any amount of restrictive covenants, let it be put in the articles of association, probably at the time of incorporation of the company, or whenever there is a change in the structure of the members at that stage, or at least before that, you ensure that the proper covenants with respect to restrictive rights are brought inside the articles of association. Now, so the restriction is only through the articles of association. The Companies Act does not specify exact form of restriction. The Companies Act, even in the table A, which has the model articles of association, there also there is no particular covenants put as to what is the type of restriction that is told in the model articles of association. So that covenants or the restriction has to be told by the company, has to be customized by the company for itself. Now then, very interestingly, restrictions, what type of restriction can be placed? What type of restrictions can be placed? Restrictions generally placed by the following two methods in the articles of association, which is number one, the right of preemption. The right of preemption means the shareholders, if there are 5 shareholders, they can say one of the shareholder wants to transfer, he should transfer it to the other 4 shareholders only. So other 4 shareholders only if they reject it, then it can go to an outside person. So the right of preemption in favor of the other existing members could be told, and it could also go to the extent of telling how the valuation of shares will be determined at that point in time. I mean, it could be told that an independent valuer appointed by the board or appointed by the transferor and transferee at that point in time, whatever you want to say, you can tell that in the articles of association, or the, I would prefer the auditor not to be a valuer at that point in time, but some of the companies I have seen saying that the auditor of the company will determine the valuation of that particular shares for the purpose of transfer. An independent auditor, an independent chartered accountant is always better than the company's auditor in that sense, is my personal view, although the auditor can also do the valuation. So having said that, that could be one of the type of restriction that can be posed. The other type of restriction which we have seen popularly is the power of the board of directors. It can be told in the articles of association that the board of directors can refuse the transfer of shares if the preemption right is not there to an outsider, if it is in good faith. So what has been a good faith itself has been a matter of great litigation. For example, the good faith has to be from the point of view of the company and not for some inappropriate purposes or some vested interest. So that is how the restrictions could be posed. The usual issue that comes out is, can there be a shareholders agreement? Whenever there is a new shareholder coming in, a shareholders agreement, can that put a restrictive covenants? We always recommend that while shareholders agreement can put a restrictive covenants, then that would be true only between the parties to the shareholders agreement. If the company has to be bound, if the directors have to be bound, if the members of the company have to be bound, it is only if it is incorporated in the articles of association of that particular company. Now, as far as this restrictive right, if it is not done in good faith, if the person who is aggrieved feels that injustice has been done to him, there is section 58, which gives the right of appeal against the refusal of the board of directors to the aggrieved party to go to the tribunal and get his rights properly placed. So what does section 58 say? 58 goes on to say board of directors to send notice within 30 days with reasons for refusal. So the board of directors are under an obligation to send within 30 days. If they accept it, yes, the transfer also has to happen within 30 days. If there is a rejection, the notice with respect to rejection of the transfer also has to be intimated to the transferor and the transferee within 30 days. And the transferee is the aggrieved party. The transferee may appeal to the National Company Law Board Tribunal against the refusal if the notice is received within 30 days. If the board hearing the parties either dismiss the appeal or by order direct registration or direct rectification of the registration. So this is the aspect which I wanted to cover. So one more aspect with respect to private limited company that we have to note is, today we have got at least 3 types of private limited companies. One is the 1% company, which I see that it is not very popular, at least in Bangalore. In Karnataka, it is not popular at all. 1%, but there is a provision for there is a provision for a 1% company to be in there. The other type of company is a small company. So what is a small company? I mean, we have actually a lot of confusion on this particular concept. There is something called a small company, then there is a small and medium company, and then now we have a medium, micro and small and medium enterprises. So what is a small company? A small company should be a private limited company. It cannot be a public limited company. It cannot be within a private limited company. If it is a holding company or a subsidiary company, it cannot be considered as small. So if you are a child of a big person, or if you are capable of having a child, then I would say child of a big person means a holding company, or if you are capable of having a child means a subsidiary company, that means you are a holding company. In that context, you will not be considered as small. So, and very importantly, the Section 8 company cannot be a small company. Apart from that, what has to be noted is that particular company's turnover should be less than 2 crores and its paid up capital should be less than 50 lakhs. So then and only then you will be considered a small company. So small company has been defined in the Companies Act. They have got certain exemptions and benefits, which we will see later on. And all other companies are called other private limited companies. So these are the 3 major classifications. Apart from that, we have a small and medium company, which we will see later on, that this particular small and medium company is there only for the purpose of getting certain benefits with respect to application of accounting standards. So let me tell you that there are recognition-based accounting standards and disclosure-based accounting standards. So there has been no relaxation with respect to recognition-based standards for even the SMCs, small and medium companies. But for small and medium companies, certain disclosure standards, for example, cash flow statement, segment reporting, small and medium less than 10 crores. So there are different categories based on which, for example, a small company ke liye, you touch the turnover of 2 crores and paid up share capital of 50 lakhs. Paid up share capital becomes the criteria. But for a small and medium company, the criteria is in terms of turnover, that is 50 crores, and less than 50 crores, and borrowing of less than 10 crores. Then there is an MSME which has not been defined here. We will see if time permits a bit later on. So then another important aspect to be noted when it comes to a private limited company is every private limited company has to be having these three restrictions in its articles of association. Then it will be its name will also be a private limited company, XYZ private limited company. Now, having said that, if this company happens to be a subsidiary of a public company, a private limited company which is a subsidiary of a public limited company will be deemed to be a public limited company. So this is very important. Although the articles of association has got this restrictive covenants and it is saying that it is private limited company by name, but the moment the private limited company becomes a subsidiary, more than 50% of the shares of a private limited company, if it is held by a public limited company, then this private limited company will be deemed to be a public limited company. Now, why is it important? Now, as I proceed further, you will see that there are a lot of exemptions given to a private limited company. So all these exemptions will be available to a pure private limited company or a small company or an OPC, because whatever exemptions are available to a private limited company is available to OPC, small and private. But the exemptions in some places have told that this is available only to OPC and small company. It is not available to other private limited companies. So we need to understand that if a company is a deemed public limited company, none of the exceptions as told in the as will be told in the subsequent slides will be applicable to a deemed public limited company. So while we are on this topic, I thought we will also refresh our memory as to what is the maximum number of partners in a partnership firm. Very interestingly, the total number of the maximum number of shareholders in a private limited company is 200, is told in the Companies Act. But in a partnership firm, the minimum number of partners have been told in the partnership firm. The maximum number of partners has been told in the Companies Act in a different way. What is said is the maximum number of members who can form a legal association without forming a company is 50. So they have put it in a different wordings. So therefore, section 464, which says that not more than 100 or such a lower number as may be prescribed can come together and form a legal association. If anything more has been, any association other than a company is formed with more than that number, then that number will be considered as an illegal association. So the maximum number of people to form a legal association by not becoming a company, will be 50. So that is what we say for a partnership firm. The maximum partners in a partnership firm is 50. This is told in the Companies Act, section 464. Initially in 1956 Act, it was told in section 11, where it said that 10 in the case of a banking company, in the banking partnership firm, and 20 in the case of other firms. So that has been struck off now. So what is now the maximum number of partners is 2 to 50. So exception to this particular rule as told in section 464 is a HUF carrying on any business or an association or a partnership formed by professionals governed by special acts. So our chartered accountancy profession is also governed by a special act. So therefore, our numbers can also breach 50 in that particular sense. In any case, if we are going beyond that number, it is better to form a LLP. So for LLP, there is no limit prescribed by the statute. So now I come to the topic proper. Having understood what is a private limited company, what are the various types of private limited company, when a private limited company, although in form, in substance, ceases to be a private limited company, is all being discussed till now. So from now onwards, we will talk about the private limited companies, exemptions and privileges. Now, where are these exemptions and privileges told? It is told in the Companies Act. When whatever is told in the Act is very easy, because it will start, these are not applicable to private limited companies, or the provision starts with in the case of every public company. So if those are the words used, then it will not be applicable to a private limited company. Sometimes the liberalization of the provision of the Companies Act is liberalized through the rules. And the Companies Act when it was newly born in the form of Companies Act 2013, lot of provisions or exemptions which are available in the 1956 Act got withdrawn in the 2013 Act. But this Act retained one of the right through Section 462 to say that if there are any difficulties faced by the companies, we will remove those difficulties through proper notification. So like that, whenever the private limited companies felt that the provisions are very harsh, they approached the ministry, and the ministry has been giving what is known as the ROD notifications. The ROD notifications are called the removal of difficulty notifications, issued under Section 462 for various purposes. And as far as private limited companies are concerned, two dates are very important in the life of a private limited company. I call that as 5th June 2015 and 16th June. You'll have this 13th June 2017. 13th June 2017. In short, June 2015 and June 2017, in short, June. June has been a very good month for private limited companies. I keep telling this because it has been raining exemptions for private limited companies. So in the next few slides, we will see what are the various exemptions that are available to a private limited company. So private limited companies, what are the privileges under the Act and the rules? So let me finish off the privileges that are available under the first two categories, that is the Act and the rules. Then I will go through those two notifications which have further reigned certain exemptions on the private limited companies. So private limited companies, number one, restriction on giving loans by companies for purchase of its shares is not applicable to private limited company. Section 67 generally debars a company from giving a loan to any of the member to buy its own shares, whereas such a restriction through the Act itself is not there in the case of a private limited company. So that is point number one. The point number two, we have already seen, right to refuse to register transfer of shares. Section 2 subsection 68, which we just now saw the definition, and read with Section 58, which gives a right for the aggrieved party to go to the tribunal, is right to refuse to register transfer of a share is available only in the case of a private limited company. In the case of a public limited company, the company has to register the transfer of shares. The third and very interesting thing, which we already saw, is no minimum paid up share capital, White Amendment Act 2015. As I already told, in the objective of ease of doing business, they have removed the minimum paid up capital. And very interestingly, not only they removed the minimum paid up share capital, today if you want to incorporate any company, be it a private in Karnataka, we have to pay the stamp duty. That's a different issue. But the filing fee, which is based on the authorized share capital, will be nil up to authorized share capital of 15 lakhs. So this is also one of the pointers in the ease of doing business. How cheap is it to form a company in India? In fact, one of the points to improve the ranking in terms of EODB, ease of doing business, for our country to go up the rank is also this particular point to say that up to 15 lakhs, there is no authorized, there is no filing up to 15 lakhs of authorized share capital. There is no filing fee with the ROC. The fourth point is directors retiring by rotation. Not applicable in the case of the private limited company. So once a director, he can always be a director. There is no compulsion that 1/3 has to retire every 3 years, like in the case of a public limited company. So 1/3 of total number of directors of a public company to retire by rotation, unless articles provide for higher proportion. So articles can provide only for a higher proportion, but otherwise this has to happen in the case of a public limited company. So minimum number of directors in the case of a private limited company, as we all know, is 2. Public limited is 3. Having said that, it's a very important point to note that in all types of company, there must be at least one director who should be resident in India. Now, the reason for this is The reason for this is if all the directors are abroad, if some criminal activity happens here and if the directors need to be arrested, that's a purpose behind which it was told in Bhopal gas tragedy. I'm sure Manoj Fadnis will be able to relate to this. In Bhopal gas tragedy, all the directors of the company were all non-residents. So whenever a criminal liability had to be levied on the directors, none of the directors were Indians for them to be arrested at that point in time. So one of the key, please keep that in mind, why this particular provision is that minimum one director should be resident in India. And for COVID reason, for the calendar year, last year and this year, they have given an exemption to this particular section 149, 1A. Now, quorum for general meeting, 2 for private limited companies and 5 for public limited company, unless articles provide for a larger quorum. And most important, which will affect our profession now, when we talk about audit, is ceiling on overall managerial remuneration is not applicable to private limited companies. Why am I telling this? Why am I telling this is because section 197 subsection 12 has told that are there, and also in CARO today, we'll have to comment as auditors whether the managerial remuneration is paid as per the ceilings prescribed. And the ceilings have been prescribed in section 197 read with schedule 5 of the Companies Act. Now, very interesting, very important point to be noted by all the auditors of a private limited company is this ceiling of overall managerial remuneration of 11%, 5%, 1%, whatever percentage we talk about is applicable only for a public limited company. This ceiling is not applicable in the case of a private limited company. A warning for those auditors who are doing audit of public limited companies, let me tell you that section 197 subsection 12 has now in Companies Act 2017 made it mandatory for it to be told in the main audit report, not under the rules, but under that, we give that books are in agreement to the financial statements are in agreement with the books and internal financial controls have been taken care of. So along in that particular line itself, we need to mention that the managerial remunerations have been given as per within the ceiling prescribed under the Companies Act. So this is a requirement for public limited companies only, let me tell you. Otherwise, for private limited companies, the ceiling is not applicable. Ceiling for managerial remuneration is not applicable. Now, the 8th one, not very important for all of us, but there as an exemption available to the private limited companies. Every company which goes to close its register of members or debentures or security holders, that means in a particular period, they have to close. If the company wants to do the dividend payment or for any other reason, they want to close the register, they can close it. But for the purpose of recording the transfers of shares or debentures or other securities, whenever the registers are closed, there is a mandatory requirement under section 91 that a newspaper advertisement must be given within 7 days before the closure of the register. Now, this particular requirement of giving an advertisement in the newspaper is not applicable in the case of a private limited company, provided all the members are informed about the closure of register 7 days prior to its closure. So that is what is the relaxation given to a private limited company. Voting through electronic means, postal ballot, and maintenance and inspection of records in electronic form is not applicable in the case of a private limited company. Similarly, report on AGM is applicable only to a listed company. So every listed company, whenever the AGM happens, the proceedings of the AGM has to be properly recorded and a copy of the proceedings has to be physically filed in an e-form MGT 15. That is applicable only, not even in the case of all listed companies, not even in the case of public limited companies, but it is applicable only in the case of a listed company. Now, disclosure of performance evaluation of board of directors and disclosure of ratio of remuneration of each director to median employees remuneration in the board's report is applicable only for, is not applicable for private limited companies, rather it is required only for public limited companies. Now, appointment of independent directors and women directors is not required in the case of a private limited company. Constitution of an audit committee of the board and nomination and remuneration committee and the stakeholder relationship committee is applicable only in the case of, is not applicable in the case of a private limited company. Contract of employment with managing director, whole-time director, not mandatory to be maintained at the registered office. So these are other minor goodies given to the private limited companies. So now we come to the exceptions, exemptions, which I told you, exemptions have come in through two ROD, that is a removal of difficulty orders, one given on 5th of June 2015, the other one given on 13th of June 2017. Now, whenever the green shade is visible, then that green shade means those are the ones which came on 13th of June 2017. If you see some of my slides here, whatever is told in green came in by virtue of 13th June 2017. So, but before I proceed any further, it has been more than half an hour since I spoke. Mr. JP, are there any questions which are interesting which we can take it up?
Sure, sir. I think one question is in the chat box.
Yeah.
So one is that how the shareholders agreement play in the case of Amazon's case with the future coupons.
Matter is sub judice. Matter is sub judice. I think there are for and against. I think future group is very strong to say that whatever we have entered in relation, it was in relation to some other company and not in relation to this company where the shares have been transferred. But whereas Amazon is telling that that particular agreement applies to all group of future group and not this particular company. So we need to see, unless I am not a privy to that particular agreement, but then both the parties are very confident. So therefore, we have to see that particular issue, how it unfolds before us.
Right, sir. Thank you. Another one is that will the restriction of maximum of 50 members apply to a cooperative society or a charitable society formed under the Charitable Societies Act?
See, what happens is, since it is Companies Act is applicable only for those which are otherwise not registered. So therefore, a charitable society or any other form which is registered under an act, that ceiling will not apply.
Fine, sir. These are the two questions.
Under the LLP Act also, there is no maximum limit as told there.
Right, sir. These are the two questions in the chat box, sir. And I am requesting the participants to make the questions to all panelists. That option, that is all panelist option. You should not make any private questions, please.
Yeah. Do we have the chairman of the session, Mr. Manoj Fadnis, there?
Yeah, I will try, sir.
No, if he's not, I mean, if he's there, he would have responded, but it's okay. So private limited companies, I mean, I wanted him to also respond in case he feels like. So private limited companies, exemptions, as I told you, all these exemptions, these two exemptions which are available through the removal of difficulties order is applicable to every private limited company, subject to one very important restriction which has been told in red there in the top, subject to the condition that the company has not committed default in filing its financial statements under section 137 or annual return under section 92. So if the company has filed all its financial statements and annual return and it is up to date, then and only then can these exemptions be claimed. Now, one of the possibilities of thinking is, suppose a company has defaulted and filed it belatedly by paying additional filing fee. Can these exemptions be taken? In my opinion, it can be taken. I mean, there are alternative views also possible, but I am telling that if the company has set right the default, then it is not anymore a default. So therefore, it can take. And while we are on this particular subject, it is good to know that the company, all the forms can be filed before 31st of December under the CLSS scheme. So please inform all the companies to file all the outstanding or forms which have never been filed since ages. You can file it without paying any additional filing fee before 31st of December 2020. So let's now talk about the other relaxations available to private limited companies. Now, as I am talking about this, please understand that some of the aspects will be relevant when I am doing an audit of a private limited company especially when I'm talking about CARO. Now, when I'm talking about CARO, I need to comment on deposits. I need to comment on related party transactions. Now, I need to comment about managerial remunerations. So those are the places where I will be spending more time, because those have implications on the audit of private limited companies also. Now, other cases, maybe if I'm practicing company law, if I'm having a company law desk in my office where I'm giving company law, consultancy, then it will be relevant. Not otherwise for the purpose of a regular audit. Now, first point is section 2, subsection 76. Clause 8 has been relaxed in the case of a private limited company to the extent to say that transactions with the holding, subsidiary, associate and fellow subsidiary shall not be treated as related party transactions. Now, this is a very important subject for us to know as chartered accountants, because in CARO I have to comment whether all the compliances with respect to section 188 has been taken care of by the company. Now, 188 is dealing with related party transactions. So I will have to say whether all the compliances with section 188 has been taken care of. So this is one slide which captures what is section 188. Whenever a company is entering into any contract or arrangement with the related party, I will have to see whether the compliances are required or not. Now, at that stage, I need to understand what is the difference between a contract and an arrangement. Normally, we say in our normal language, contract and arrangement. Now, why did they use the word contract and arrangement? It is for a reason. Contract is that which is in writing, that becomes a contract, and arrangement is that which is not in writing but is being carried out. In accounting standard language, we consider that as there is something called a legal obligation and there is something called a constructive obligation. So what is a constructive obligation? And let us say if I have been paying bonus, in the record I have told that I will pay 1 month bonus, but every year the company has been paying 2 months bonus. So there is a legal obligation to the extent of the first month, and there is a constructive obligation to the extent of the second month, that is the plus 1 month. So if the company has to prepare an accounting standard 15 provision for the next year, I will say that it should be for 2 months. Whereas the company will come and say, no, the actual legal obligation is only for 1 month. Then accounting standard 15 says you shall construct the obligation based on the past practice. That is why the word arrangement or the transaction which happens not by virtue of a contract but by virtue of practice without a contract is called an arrangement. So company entering into contract or arrangement with related parties. Now, who are related parties? The Act has gone to define under section 2 subsection 76 about 9 related parties. Now it starts with related party with reference to a company means director or his relative. So director is of course a related party, and any of the relative of a director. Very interestingly, Jaman George is here, I'm sure. Jaman, I always ask this particular question. Who is a relative? Relative in the case of as per the Companies Act has been defined as relatives have been defined in different acts in different ways. The simple definition of a relative is there actually in accounting standard 18. Accounting standard 18, Aju Baju, Aage Piche, just upar, just niche. When that is Aju Baju is husband and wife, Aage Piche is brother and sister, just upar means mother and father, just niche means son and daughter. That is the definition of a relative under accounting standard 18. Under Income Tax Act, definition of a relative is Aju Baju, Aage Piche, upar niche. Husband and wife, brother and sister, lineally ascendant and lineally descendant. So what is the difference between Income Tax Act and companies and accounting standard is in the case of income tax, grandfather is a relative. In the case of accounting standard 18, grandfather is not a relative. Now, Companies Act borrows from accounting standard 18. Companies Act borrows from Accounting Standard 18, but adds 2 more relatives. So Accounting Standard 18, Aju Baju, Aage Piche, just upar, just niche, and it adds 2 more relatives, that is the son's wife and daughter's husband. Son's wife is daughter-in-law. I mean, if it were to be a real session, I would have always asked, daughter as per which law? Now then I say daughter as per company law. So son-in-law, that means daughter's husband is also a son as per company law. So now son-in-law, daughter-in-law, father, mother, son, daughter, husband, husband and wife, or brother and sister. So these are the relatives for the purpose of Companies Act. So director or his relative. Then key managerial personnel. So we know who the key managerial personnel is. I will not get into the details of that today. Key managerial personnel, company secretary, managing director, whole-time director. Now all these CEO, CFO, these are all the key managerial personnel, or the relatives of the key managerial personnel are also related parties. So how do you relate this? Now, whenever a company is entering into any transaction between the company and, let us say, the daughter-in-law or the son-in-law of the director of a company, then you'll have to test for the other aspects as told below. So that is how the related party will be looked into. So key managerial personnel or his relative. That is the second type of relation. In fact, what I have put on the extreme right is a director is one relative, one related party. Relative of director is a second related party. That is how you have 2 there. Key managerial personnel is one. Relative of a key managerial person is another one. So that is a second type there on the right side. The third type is firm in which the director, manager, or his relative is a partner. That means a partnership firm in which the director of the company is a partner, a partnership firm in which the manager of the company is a partner, or a partnership firm in which the relative of a director is a partner, or a partnership firm in which the relative of a manager is a partner. So that is how the third type of relationship can actually end up with 4 different types of relationship as you see in the extreme right. Then a private company in which director or manager or his relative is a member or a director. So the private company, in this company, is transacting with another private company in which the directors are common. The director of this company is a director of this particular company, or the director of this company is a manager of this company, or a manager is a manager of this company, or his relative is a member or director. Now, very important. Here, in the case of a private limited company, it is sufficient if the director of my company is a shareholder in another company. So private company in which the director or manager or his relative is a member, that is a shareholder of that particular private limited company, or is a director of that particular company. So when it comes to public company in which director, so if the company is transacting with a public company, if a company is transacting with another public company in which the director manager is a director and holds along with the relatives more than 2% of its paid up share capital. So how do we look into this relationship? Is a company is there, my company is transacting with another company which is a public company, and in that particular company in which the director of my company is a director in the public company and holds more than 2% of its paid up share capital. If he's just a director, then he becomes an independent director, then it is not connected. But if he's a director and holds more than 2% of the shares in the public limited company, then these 2 companies are said to be related. Like that, they have defined any body corporate whose board of directors or manager is accustomed to act. Any person on whose advice, directions or instructions a director or manager is accustomed to act. Holding, subsidiary, associate, fellow subsidiary. Then they introduced 2 more terminologies in the Companies Act 2017, which is investing company and venturer company. Now, what is this investing company and venturer company? Let me ask this question to Jayaprakash. Jayaprakash ji, if I am holding more than 50% in your company, I am a holding company and you are a subsidiary company. You are a subsidiary company. Now, if I am holding more than 20% in your company, if I am holding more than 20% shares in your company, you are an associate company because I am holding more than 20% in you. Who am I? Who am I? I mean, for that, there was no reason, I mean, there was no particular terminology as to who am I. Holding and subsidiary. The person is holding and subsidiary. That means more than 50%. This company is subsidiary company and this company is holding company. If I have invested 20%, less than 50%, this company is my associate. But who am I? Was not known. Companies Act 2017 went on to say who I am. A person who is investing in an associate company is called either an investing company or a venturer. So that is a new terminology which they introduced. Having said that, who is a fellow subsidiary? A fellow subsidiary means if the holding company has got two subsidiary companies, the holding company has got two subsidiary companies, H has got S1 and S2, the relationship between S1 and S2 is called fellow subsidiary. So now what they did was, and such other person as may be prescribed. So this is also one type of relationship. Such other person as may be prescribed. Director other than independent director, key managerial personnel of the holding company or his relative is another thing which they have prescribed now. Now what is the take home point from this? We now just understood who the related parties are. And then we'll have to see whether it is done. I mean, I'm not talking about 188 very detailedly. I'll just curb it here and proceed further. What is 188? 188 goes on to say, if it is a transaction with the related party, check whether it is done in the ordinary course of business and at arm's length. If it is done, if the answer to that is yes, no action required under 188, but disclose in director's report. If it is not in the ordinary course of business, or it is in the ordinary course of business but not at arm's length, then you check whether they are related party transactions stipulated. Section 188 goes on to define 7 different types of transactions. Not all transactions are related party transactions. So they have gone to say what are the various 7 types of transactions. So if it is that, then if it is not a related party transaction, 7 types, then no action required. If it is within that 7 type, we'll have to see whether it is breaching the limit. They have told 10% limit. Well, for today, I'm just saying 10% limit breach. If the limit is within the 10%, then take a board's content and proceed with the transaction. If it is breaching the transaction limit of 10%, then apart from the board's consent, there must be a prior ordinary resolution passed by the shareholders. So that then there are other elaborate requirements. So that is about the entire transaction. What the relaxation in the ROD went on to say is, in the case of a private limited company, the 8th type of relationship, that is, if I am a private limited company and I am dealing with my holding company or my subsidiary company or my associate, fellow subsidiary, or along with my investing or venturer company, then that transaction will not be considered as a related party transaction. So that is the relaxation which is given by the ROD notification dated 5th June 2015. So in the case of a private company, HSAF, that is holding subsidiary, associate, fellow subsidiary, is not treated as a related party transaction. But a word of caution here. What is a word of caution? If you see below, I have given it. Beware, in private companies, holding subsidiary, associate, fellow subsidiary, investment and venturer are not related parties as per ROD notification. But could be related parties if they fall in any other criteria, such as common directors. Now, how do you see this? If, let us say, if they are a related party by virtue of point number 4 or 5 above, although I am having a holding company and I am a subsidiary company, but if this holding company is not considered as a related party under point number 8, but by virtue of point number 4, if there are common directors in a private limited company, if there are common directors, then I am afraid that under point number 4, they will be considered as related party transactions, and you have to go through this entire flowchart. Having said that, another point to be noted is, in the case of a holding subsidiary associate, although the relaxation has been given for the purpose of accounting standard 18 disclosures, there is no relaxation. So that's a point to be noted. So let's go quickly to the other aspects. Section 43 and 47. In the case of a private limited company, provisions regarding kinds of share capital and voting rights is not applicable if memorandum or articles provides. So you can have a clause in your articles of association saying that equity shares with differential voting rights can be issued without any conditions or restrictions. This can happen in a private limited companies. Very interestingly, we also know that in the case of a preference shareholders, if dividends are not given for 2 years, they have the right to vote in the company. Whereas such a right can be taken away by the articles of association is what is possible by virtue of this removal of difficulty. That's why I said articles of association can provide for no voting rights to preference shareholders, even if dividends are not paid for 2 years or more. Next, section 62. Rights issue offer to be kept open for a minimum 15 days and a maximum 30 days. This is the requirement under section 62 whenever rights issue are allotted. Dispatch of letter of offer 3 days prior to the opening of the offer. So these are all the requirements under 62. What the ROD went on to say is period can be lesser than 15 days, provided 90% of the members give their consent. So this is one of the relaxations that have been given to private limited companies. Section 62 goes on to say for issue of ESOP, an ordinary resolution can be passed instead of special resolution. Section 67, if you remember, we had seen earlier, in the case of a private limited company, I can give loans to members to buy shares in me. That is what is already there in the Act. But here it has gone a step further. Restriction on power to buy its own shares. That means the company itself can buy its own share. It's a private limited can buy its own shares subject to certain conditions. Subject to 3 conditions as specified under section 185 below. So you will see what those 3 conditions are when I deal with 185. Section 73 subsection 2, very dangerous section. Let me tell you, in the Companies Act, there is one dangerous section, one dangerous chapter called chapter 5, dealing with deposits, dealing with only 4 sections, 4 or 5 sections you may say, 73, 74, 75, 76 and 76A, dealing with the deposits. The most dangerous sections or provisions. I call it dangerous because even if the company inadvertently collects money which falls into the category of deposits, then the penalty is very high, so much that it can be up to 10 crores. It can be up to 10 crores penalty. So therefore, please, as auditors also, we have to comment it in Caro. So therefore, I thought I will spend 5 or 10 minutes in understanding what this chapter on deposits is all about. Let me just take you through the chapter of deposits. When I have tried to explain these 4 sections in the form of one flowchart here. Acceptance of deposits. What is acceptance of deposit? Deposit accepted as such nahi hai. Any money collected by a company is deposit. Any money collected by a company is deposit unless it fits into the green category. There are certain exempted deposits. That is called popularly as Rule 21C. Now, if it is Rule 21C, if they have defined about 18 categories of money which is received, which if it is received, it will be considered as exempt. There's no problem. Otherwise, it will be considered as deposits. Any money collected will be considered as deposits, unless it falls into the 18 green categories as is told in slide number 12. Now, what are there are a lot of conditions. One is members, then I'll have to say whether it is from members means shareholders or from non-members. So let me now make it very simple. From non-members, only eligible public companies can take. So what is an eligible public company? A company with net worth of more than 100 crores or a turnover of more than 500 crores. So we will not talk about that. So they are considered as eligible public limited companies doing elaborate compliances. They can under section 76 go in for collecting deposits from public. That means not shareholders. Now in the case of members, the compliances have been told under section 73 subsection 2. So section 73 subsection 2 now talks about public limited companies can take money from the shareholders up to 35% of their net worth, complying with conditions. Very important. Today I'm not talking about the detailed conditions. I'm just leaving at that. Whereas in the case of a private limited companies can take money again complying with certain conditions. There are relaxed conditions. There are a lot of conditions. Condition number A to E need not be complied with. Condition number A to E, as told in the company's acceptance of deposit rules, need not be complied with, provided it takes money up to 100% of the net worth. Up to 100% of the net worth. If in the case of a private limited company, it can also collect beyond 100% of the net worth, provided three conditions are complied with. What are those three conditions? The company which is collecting deposits should not be an associate or subsidiary. That means I should not be invested. I mean, no other company should have invested more than 20% or more than 50% in me. Point number 2, borrowings from banks, financial institutions and body corporates divided by paid up capital. That ratio should be less than 2, or the borrowing should be less than 50 crores. I mean, even if the ratio is within 2, but my total borrowings is more than 50 crores, then I will not be eligible for this, unlimited borrowing, unlimited money taken as deposits from the members. Third one, no default in repayment of such borrowings. There should not have been any default in the past with respect to such borrowings. Then you can collect any money as deposits from the shareholders. And incidentally, in the case of an eligible startup, I mean, in Kerala, I don't know whether there are a lot of startups. In Bangalore, there are a lot of this. Bangalore is now called as the startup capital of India. So what is a startup? They have defined a startup as a company which is coming out with some niche products or niche services, or giving out tremendous amount of employment and registered with the DIPP. In that context, 10 years from the date of incorporation, any amount they can collect without complying this particular conditions. So what I wanted to tell you is introduce you to the chapter of deposits, and in case you do not fall into any one of these categories and still you have collected deposits, that means not being 2(1)(c), not complying with the deposit rules, then the contravention which I told in the extreme right on the top, contravention will lead to a penalty of 1 crore to 10 crores. And in the case of a company, and in the case of an officer in default, 25 lakhs to 2 crores plus 7 years rigorous imprisonment. So therefore, this has to be avoided. So in the case of a private limited company, there has been a relaxation from when you are collecting monies from the members up to 100% of the net worth of the company, you can collect it, provided a disclosure is there in the financial statement. And any amount you can collect, beyond 100% also you can collect, provided you are complying with the three conditions as told below. For a moment, let me also spend some time in understanding what are the 18 varieties of exempted deposits. Rule 2(1)(c), deposit includes any receipt of money by way of deposits or loan or in any other form by a company, but does not include any amount received from central government, state government, local or statutory authority. Foreign persons, if I receive any amount from foreign persons, as long as it complies with FEMA, it is okay. Any amount taken from loans or facility from banks. Please note that this is a very important aspect for all the chartered accounts, even for audit, because I have to say whether the company has complied with the deposit rules. If there is any breach, I have to bring out that breach in the CARO report. So loans, facilities from the banks is considered as a green deposit. Loans, facilities from public financial institution is considered as exempted deposits. Commercial papers, intercorporate deposits. My company taking money from another company is considered as exempt. Security application money is share capital deposit, means share capital is not deposit, it goes as share capital. But if I have collected share application money and I have not allotted shares within 60 days, so maximum up to 60 days I can keep it under share application money. Beyond 60 days, it will become red deposits. And I mean, I just do not talk about red deposits. I mean, here, if you see the pictorial manner in which it is shown, there is something called a green deposit, a blue deposit, and a red deposit. A green deposit is that which falls into any one of these 18 categories. Blue deposits are deposits taken from members and non-members in the case of eligible public limited companies, and within members subject to certain conditions. That means you have complied with all the requirements, then it is a blue deposit. Then we have a contravention. That is the red deposit. That means money taken, contravening. So if the share application money is not returned, is not capitalized and not returned within 60 days, it becomes a case of red deposits. So why did I come to this slide? To say that a company can collect any amount from its directors, and in the case of a private limited company, it can collect even from relatives. It can collect money even from relatives of the directors, not relatives of the shareholders, relative of the directors. So relative of the directors, relative I already told you, aju baju, aage piche, just upar, just niche. So if or the son-in-law and daughter-in-law. So if a director has taken from his father-in-law, director has taken from his father-in-law, a father-in-law is not a relative of the director for Companies Act purpose. He can take it from his son-in-law or his daughter-in-law or his wife, mother, father, sister, brother. Now these are only the defined relatives. Or if the director happens to be a wife, from her husband. So otherwise, and relative of a director, very interestingly, is taken at the time when he was a director. Subsequently, if he retires as a director also, then that money which is collected continues to be under the green deposit or exempted deposit. But the conditions if you are taking from a director or a relative of a director is, there is one very important condition, that they should give a declaration that it is not borrowed out of, amount is not invested by borrowing it from elsewhere. So a declaration has to be given by a director or a relative of a director that the money which is brought into the company is not out of borrowed funds, So similarly for debentures, any amount taken from employees, non-interest bearing amount and held in trust, unsecured loan from promoters, if it is brought in as a margin money as stipulated by the banks, any amount accepted by the Nidhi company, any amount received in the course of or for the purpose of business of the company as advance from customers up to 365 days, advance for immobile property, security deposit under contract, advance for long-term projects being capital goods, advance for future services as per normal business terms or up to 5 years, whichever is lower. Normally happens in the case of a car company, I give an advance warranty for 3 years, then that beyond 365 days. So that is also okay. Advance received and allowed by sectorial regulator or with central government and state government directions. Advance for subscription towards publication is all considered to be green accepted deposits. Chit subscriptions as per chit fund, collective investment scheme, and up to 25 lakhs in single tranche by a startup company, and alternative investment funds collected by the companies, all considered as green. Today my focus is not on deposit, but to talk about the exemption available to a private limited company is what we saw. Directors in the case of every company, relative of a director in the case of a private limited company. So from 15th September 2019, this is one slide, how the relaxations went on in the case of a private limited company with respect to deposits. So as it stands, directors, you can take it. Relative of directors, you can take it only in a private limited company. Members, which are now, whether you are collecting exempted deposit, that is green deposit or blue deposits, you shall file DPT3 annually. And there should be a declaration that it is not out of borrowed funds if it is from directors or relatives of directors. And also this should be disclosed in the financial statement. So these are the conditions required there. So we go back to the other provisions. 101 to 107 and 109, general meeting provisions, not applicable. General meeting provisions, that is meeting for members with respect to notice, explanatory statement, chairman, quorum, proxy, relaxation on voting rights, voting by show of hands and demand for a poll. There are things which are already told in the Act. However, the Act itself has told that you can relax any of the provisions as told in the Act through your articles of association as far as the private limited companies are concerned. Not applicable if articles of association provides otherwise. Section 117 subsection 3G, filing of MGT 14. MGT 14 is not applicable for board resolution except for resolutions relating to managing director. Now we will see quickly when we have to file a MGT 14, very important form which needs to be filed by every company. Whenever there are resolutions, special resolutions passed, yes, the company has to file an MGT 14. Resolutions agreed to by all members, the company has to file MGT 14. Board of Directors resolution relating to appointment, reappointment, renewal or variation of terms of appointment of managing director has to be filed. resolution agreement which have been agreed to by any class of members, all voluntary winding up of resolution, and resolutions passed by board of directors under section 179(3) has to be filed. Any other resolution agreement placed in public domain. Now, in the case of a private limited company, every board resolution need not be subject to filing of MGT 14. In the case of a public limited company, every board resolution passed under 179(3) has to be subjected to MGT 14. Now, in the case of a private limited company, when shall you file MGT 14? Whenever there is a special resolution or a resolution passed by all members, or a board resolution approving the appointment, reappointment, or change of MD's appointment, then resolution passed by a class of members, voluntary winding up, and resolutions in public domain. So all other things you will have to file MGT 14. One other important thing which is good for the chartered accountants, that is section 141 subsection 3G, is audit of 20 companies ceiling. An auditor can audit only 20 companies at most. If it is a firm of 3 chartered accountants, 3 into 20, 60, 2 means 2 into 20, 40. So that is how the total number of audits we could have done. Thankfully, by virtue of this relaxation, they said audit of 20 companies ceiling not applicable to private companies with paid up capital of less than 100 crores, OPC, dormant company and small company. But we have to be very clear that the ceiling of 30 companies audit per chartered accountant, as told by the Institute of Chartered Accountants of India's Code of Ethics, will continue. So beware, 30 companies audit ceiling of ICAI with sublimit of 10 public companies with paid up capital of more than 25 lakhs is still that particular ceiling has to be considered. So section 160 goes on to say right of persons other than retiring directors to stand for directorship. Not applicable. What this goes on to say is any person who is wanting to appoint a new person has to give 1 lakh as deposit to the company. This is there only for public limited companies, not for private limited companies. So we have seen all this. So we quickly go forward to see the balance. What are the other exemptions available? So just now we saw certain exemptions available on 5th June 2015. Now we are seeing 13th June 2017 relaxations given to private limited companies. There, I told you certain these exemptions which are given on 13th June marked in sort of a green shade is if and only if it is a OPC, that is a private company which is an one-person company, small company I have already defined as less than 2 crores turnover, less than 50 lakhs paid up capital, dormant company and startup company. So financial statements not to include SMC also gives me that particular. In the case of 92, annual return need not be signed by a practicing company secretary. In the case of 173, there has been some minor relaxation only for not all private limited companies. Let me tell you, only small companies, dormant companies, startup and OPC. They said mandatory 4 board meetings for including the private limited companies, other private limited companies. There is a mandatory requirement of holding 4 board meetings with a maximum time gap of 120 days between the 2 board meetings. In fact, for COVID special, they are given an extension of another 60 days between for the maximum period. So today maximum period can be up to 180 days up to 30th September 2020. Now for such companies, that is OPC, small company, dormant company and startup companies, at least 1 board meeting in each half year of the current year and gap between 2 meetings shall be more than 90 days. Now, private companies, if and only if they are small companies, there's some small relaxation. Annual return, that is MGT 7, instead of remuneration of directors and KMP, instead of giving the complete breakup of remuneration and KMP, can give aggregate amount of remuneration drawn by the directors. Now, one very interesting thing which came in as a relaxation from 13th June 2017 is for the auditor to whether or not to include in his audit report another audit report on internal financial controls. When the past president, Mr. Manoj Fadnis, went on to talk about SA 315, very important. He went on to talk about transactional audit. Gone are the days when we do a transactional audit. Today we are looking into whether the systems and controls are okay. If the systems and controls are okay, then my transactional audit will to that extent come down. That is what is SA 315 all about. So what? And then we go on to say whether the systems and controls, whether the internal financial controls are okay, we have to give a separate report. We give an audit report and an IFC report. In the audit report, I will go on to say what has gone wrong in the last year in the financial statements. Does the financial statement depict truly and fairly the transactions that have happened in the company? If not, what are things which have gone wrong in relation to the standards which are not properly depicted in the financial statements? That is our main audit report, the true and fair audit report. Now, in the case of an internal financial control report, I will not, while I'm concerned with what has gone wrong, I will be more concerned with what can go wrong. That means this year everything is fine, but there is a possibility that in the next year there can be certain trouble for the company because the internal controls are weak. So I have to study that systems and controls to say whether the brakes are properly working. When I always put it in a very, very different way. JP, are you there?
Yes, sir.
I would like to ask you a question. Now, Bangalore to Mysore, I go in a car and reach in 1.5 hours. Okay, right. I reach in 1.5 hours. And then there is another partner of mine, let us say partner X, who takes 3 hours to go from Bangalore to Mysore. Which car would you go in? 1.5 hours car or 3 hours car?
That will depend, sir. Depend upon the situation.
Okay. Let me tell you what I know. You have given a wonderful answer for that. Then I will tell you that in my car there are no brakes.
Right.
In my car there are no brakes. Or the brakes are there, but it's behind my back. Now, what we talk about, controls missing. I always take this example. I may reach the destination. I have reached the then I will tell you that in the last 10 years I have been going in 1.5 hours, no problem, and there was never an accident. Then in the main audit report, I will say he has reached from destination A to destination B in the last 10 years. There's no problem. But in my internal financial controls, I will say there are no brakes in the car. Now there are no brakes in the car. So if there is a risky investor who feels that no problem, he has not, I will go with his past experience, then he may decide to join the company. But most of them, like what JP said, they may decide that they may not like to go in this 1.5 hours car, they would like to go in the 3-hour car. So internal financial control is like whether there are proper controls. A brake is a very important control in a car. So just like that, not only presence of internal financial controls, then whether they are operating effectively, that means I told you the brake is behind my back, that every time I have to apply a brake, I have to turn back and apply. So then there is again a possibility of an accident. Or the brake is there, but I have put my legs and sitting on the car as though I'm sitting for some lunch. So that means it is not being effectively utilized. So all these things, the auditor of a company should not only concentrate on accidents which have happened, the qualifications which have to be reported may not be there because everything has been okay, but the possibility of a qualification, the possibility of an accident in the future years is what is going to be commented in an internal financial control report. Every company had to give an internal financial control initially when the Companies Act came out. First 2 years they gave a relaxation. Afterwards, then they said for a small and less complex entity, especially in the case of a private limited company, only between husband and wife, directors or whatever. So why should we talk about wherever there is a difference between management and the shareholders, then it is right. But otherwise, there is no point in giving an internal financial control report. They gave a relaxation. So today, in the case of the following company, the adequacy, the comment of the auditor with respect to internal financial control, its adequacy of financial control with respect to financial statement need not be commented by an auditor of a OPC or a small company or other private company with a turnover of less than 50 crore and borrowings from banks, financial institutions and body corporate of less than 25 crores. If these conditions are complied with, the the auditor need not comment separately on the internal financial controls. But even in these contexts, I always say that the auditor has to look into the controls for the purpose of giving the overall observation, but need not specifically give an observation on the presence or absence of internal financial controls. So those are the relaxations for private limited companies. Quickly, we will see small companies. We've already seen the definition. What are the exemptions available to a small company? Exempt from preparation of cash flow statement. Annual returns, they have been given certain relaxations. Minimum two board meetings instead of 4. Then simplified provisions of merger. Then we also, in the below, I have given you relaxation for micro, small and medium enterprises. Just to compare small company, MSME, whereas small company is in relation to turnover and capital. MSME today, with effect from 1st July 2020, is in relation to investment in plant and machinery and turnover. Investment in plant and machinery, they said returned on value as per Income Tax Act, not the purchase value as it was earlier. And turnover excludes export turnover. Very interestingly, manufacturing services are covered, traders are not. And I think last Sunday, Deepavali, there was a gift saying that automobile dealers will also now be covered under MSME. So that's a small relaxation. And the cutoffs, I'm sure most of you know about that. Small and medium companies only for the purpose of relaxation in certain accounting standards, which I'm sure MP Vijay Kumar will cover when he talks day after tomorrow. So I'm not talking about this. But this is one slide which I wanted to talk about. Also, we may think that I am a private limited company, all these provisions applicable to me. Let me tell you, the following provisions are applicable even in the case of a private limited company. So what are they? CSR. Applicable to a private limited company also, if his net worth is more than 500 crores, turnover is more than 1000 crores, or net profit is more than 5 crores. The moment it crosses 5 crores, and profit there is PBT, it is not PAT, profit before tax. So if the profit before tax is more than 5 crores, CSR of 2% will have to be spent by even a private limited company. Internal audit, if the borrowing is more than 100 crores and turnover is more than 200 crores under 138, there is a requirement for a company to have, even in the case of a private limited company, to have a proper internal audit mechanism. Rotation of auditor is also applicable to a private limited company whose paid up capital is more than 50 crores, borrowings or deposits is more than 50 crores. Appointment of whole-time company secretary is also applicable in the case of a private limited company. If the paid up capital in the case of a private limited company is more than, originally it was 5 crores, now they have increased it to 10 crores. Now, appointment of other KMP under section 203 is not applicable to a private limited company as told in hash below. Taro, very important, I'm sure all of us know that it is also applicable to private limited companies whose paid up capital, including reserves and surplus, one may say net worth itself is more than 1 crore. Borrowings from banks, financial institution is more than 1 crore, or turnover is more than 10 crores. So any one of them breaching, CARO will be applicable. Annual return signature, annual return certification, vigil mechanism, secretarial audit will all be applicable. In fact, secretarial audit is a new provision which has come out from 1/4/2020. From April 2020, every private limited company also having a borrowing of more than 100 crores should have a proper secretarial audit conducted by a practicing company secretary. Cost audit and records. Cost audit and records is also applicable to a private limited company. But one very interesting observation which I've given in a dollar sign below is the cost audit, records and rules, cost audit, record rules audit 2014 will not be applicable to a company classified as micro or small enterprise as per MSMEDA Act. I now come to the last leg of my session, which is audit of private limited companies. I will cover it up in the next 10-15 minutes, and then I'll spend some 5 minutes on the notice which I said will be given to a chartered accountant. Then I will take up as many questions as possible on the subject that I have just now dealt with. And I'm sure I told you about Manoj Fadnis, but then today I also have the August company of Jaman George, who is also a master in audit and master in company law. And he can also join me in answering some of the questions posed to me. So journey of important provisions relevant to accredited companies. That means I am a private limited company. I have another subsidiary, which is a private limited company. Now, should I consolidate these two? The answer is yes. Originally, Accounting Standard 21 did not tell me that consolidation is a must. 1956 Act also did not tell me consolidation is a must. But today, Companies Act tells me whenever there is a holding and subsidiary relationship, consolidation is a must. Now, the only relaxation applicable to all except intermediate subsidiaries is subject to certain conditions. Now, what is that? What does that mean? You look into the second aspect. Now, company A is the holding company. Company B is the subsidiary company of A. C is the subsidiary company of B. So A is the holding company of B. B is the holding company of C. Now the question is, A will prepare a consolidated statement of B and C. So A, B, C will be one consolidated financial statement. Now, should B prepare a consolidated statement of C? B and C, should it prepare a consolidated financial statement? The answer was yes, unless there came a relaxation in 2016. Dated 27th July 2016, they gave out a relaxation to say that relaxation from preparation of consolidated statement by the intermediate subsidiary company. So A, B and C, A is holding B, B is holding C. So B is the intermediate subsidiary company, okay, wholly owned or partly owned, if and only if B need not consolidate C's financial statement, if all the members of company B, all of them do not object to the company not presenting consolidated financial statement, and B is not a listed company, and its ultimate holding company, that is A, prepares a subsidiary, consolidated, including the intermediate holding company, and files it with the Register of Companies in India. So then that is how the relaxation has come in. Component depreciation is mandatory. CARO version 2016 is mandatory as of now. Version 2020, thankfully, what was applicable from this year has moved to next year. Otherwise, CARO 2016 has got 16 points with several sub-points. CARO 2020 has got 20 plus 1 point. One is in relation to consolidation. So 20 points. Out of that, 2 points are most dangerous. Point number 1 to say, whenever are they in agreement with the books as on those quarter ends. Most difficult, and I have seen in practice none of the private limited companies will actually have a closure of their books of accounts, and they don't give their statement from their books of account. Rather, it is worked backwards to say, sorry to say this, some of the companies work out drawing power and then work backwards and say this is my stocks. That is going to be very dangerous. So please warn all such type of private limited companies. From next year, we are going to act as the watchman for the banks to say if it is not in agreement with the books, we may have to say that it is not in agreement with the books, and please warn them accordingly. One more tough provision in the 2020 CARO is in relation to whether the company is capable of meeting its financial commitments in the next 1 year. Very difficult to say this. It is going ahead of going concern itself. So that is a point which we'll have to be ready with. CARO for consolidated financial statement not required. Internal financial controls we just now discussed. It is mandatory but not applicable to private limited companies subject to certain conditions which we have discussed. Prohibited services under 144 is also applicable for private limited companies. Fraud reporting is also applicable to private limited companies. Accounting standard revised version from 2016-17 onwards, there has been a revised version. I would say 2 very important things to be noticed by every company, mostly private limited company. Proposed dividend, accounting standard 4 has got amended, wherein proposed dividend will only come as a disclosure and will not come as a provision in the balance sheet. Accounting standard 6 has got depreciated. Accounting standard 6 has got depreciated and has got absorbed. The provisions of accounting standard 6 is now dealt with accounting standard 10. Accounting standard 10 today deals with deals with only property, plant and equipment. The name has got changed from fixed asset to property, plant and equipment. In fact, not only the standard name, even the financial statement, the name of the schedule, it cannot be any more fixed asset schedule. It should be property, plant and equipment schedule. And there are a lot of changes in Accounting Standard 10, which I'm sure MP Vijay Kumar will deal with. Yeah. Now let me just conclude by this particular snapshot. JP, can I go ahead? Can I borrow another 15-20 minutes?
No issues, sir. No issues. Still more than 600 participants are there.
Fantastic. No, that's okay. But then we need to respect all the 600 into 15 minutes. 600 into 15 minutes. But then I think it would be interesting. And anyway, people have the option of quitting in case they have something more important. So snapshot of audit as per SA 700, 705, 706. When I just cover it in my own way in one slide. In fact, if you look at our audit report, we are giving 4 reports in one. When I will call it as buy one, get 3 free. When we are reporting on 4 different aspects in our audit report. Report on the financial statements, report on other legal and regulatory requirement covering CARO report and IFC report. CARO report and IFC report. So let us see this particular the various aspects to be taken care of. The format has got changed. We are used to that format since last year. Opinion at the beginning, qualified opinion, adverse opinion, disclaimer of an opinion. So if I start with a qualification, then the heading of the report itself will be called a qualified opinion. If it is a clean opinion, I just give opinion. And if it is an adverse opinion, the heading itself will be adverse opinion. Then immediately I will give a basis of opinion. And if it is a qualification, then I say basis for qualified opinion, basis for qualified opinion, basis for adverse opinion, or basis for disclaimer of an opinion. Then I go on to say, what could be the basis for my clean opinion? Basis for my clean opinion can be 4. That is, I have audited as per standards on auditing. Then I go on to refer to auditor's responsibility paragraph. I mean, I will have a whole lot of responsibility which I own up. Then refer to auditor's independence and independent ethical code of ethics. When I will say I am auditor, I am independent of the company, I am ethical, I am following ethical practice, and I follow my code of ethics. And finally, I say I have obtained sufficient and appropriate audit evidence. So I have obtained sufficient appropriate audit evidence is what I will finally conclude. This is the basis. And if it happens to be a basis of qualified opinion, then I will say what are my qualifications? What are my qualifications? Accounting Standard 15 has not been complied with. This again what I give below. Then material uncertainty. The third paragraph is material uncertainty related to going concern. Now this, as I told you, if needed. So if there is a doubt that the company has got certain issues, may or may not go on, is what I feel. But the company has sufficiently given me a response to say that these are the reasons why I feel it will continue beyond 1 year. Now, if there is an uncertainty, but I'm convinced that this uncertainty can be overcome. Management has convinced me that this uncertainty can be overcome. I would still give a paragraph under the third paragraph called material uncertainty relating to going concern. So I will say what are the reasons for why I am saying it as the going concern. I will say that the net worth has gone negative, and then the company is continuously in losses. But the directors will say we have a holding company which has assured that enough funds will be put into the company to take care of its requirement. So that is the mitigation for the uncertainty. So I will bring out the uncertainty. I will also bring out the mitigation in this particular paragraph. So if the company is good, there is no problem with respect to going concern, then I don't have to give this item number, row number 3. Earlier, before this revised format came into picture, I used to give it under emphasis of matter. Now it is to be given as a separate heading immediately after the basis of opinion, because they feel that in the emphasis of matter, certain other matters could get camouflaged. So this particular paragraph is so important that it needs a separate announcement through a separate headed paragraph. Emphasis of matter. So what is an emphasis of matter? This is coming out of SA 706. If a matter is already there in the financial statement, which is properly dealt with, not in the form of a qualification, but an auditor feels that it is of a fundamental use for the users of the financial statements to know that particular aspect, because there are so many aspects in the financial statement. So I would draw the attention of the reader to that particular aspect. Then I will emphasize, please understand, I will emphasize, I always say that there is a pointer to a note in the financial statement that, look, there is a huge contingent liability, there is some tax problem, some issue with some other company, so which is already told there, but I will draw that my attention to in my audit report. Not applicable to private limited companies. So out of all the matters, which is that one matter which has taken a lot of your time to resolve, but you have properly resolved it. So key audit matter is a matter which is very critical to the company, and the auditor has taken more time to resolve that particular issue. That particular matter will be brought out. This is mandatory in the case of a listed entity as of now. For a private limited company or any other public limited company also, it is not mandatory. So may be placed before EOM. That placement they have given a sort of small option. Other information. Now please understand, other information is not the same as other matter. Other information is coming by virtue of SA 720, which is mandatory even in the case of a private limited company. What is other information? Now, if you look into the annual report of a company, it consists of audit report, it consists of financial statement. You remove the audit report and the financial statement. What is a financial statement? A financial statement consists of 5 important elements: balance sheet, profit and loss account, explanatory notes, cash flow statement if applicable, statement of changes in equity if applicable to Ind AS companies, and other explanatory notes. So these 5 become financial statements. So in the annual report, if you remove the audit report and the financial statements, what remains is the other information. So that could be director's report, that could be management discussion analysis, that could be certain graphs, whatever press notes, whatever you have covered it in your annual report, chairman's speech. So all these things could be other information. So in the annual report minus auditor's report minus financial statement is other information. Now SA 720 goes on to say that every company shall give a paragraph on other information. And in that paragraph, the auditor has to say whether the information contained in other information is falling in line with those contained in the financial statements. For example, the turnover in my audited financial statement is 200 crores. But the chairman's speech says, we are very proud to announce that the turnover for the year is 225 crores. That means there is an inconsistency in the other information in the annual report and the financial statement. Then now SA 720 goes on to cast a responsibility on the auditor to ensure that there are no inconsistency, not only in the audited financial statement, but in the other information in the annual report, because let us understand that a person who is reading the financial statement, the annual report, thinks that the annual report is audited. Whereas we have never audited the annual report. We have audited only the financial statement. So now an additional responsibility is cast on the auditor to look into the other information and tell the management to correct wherever there are inconsistencies. If the correction does not happen, then he has to qualify that in the audit report. Now $1 million question. When I have signed the financial statements, the other information is not available. So how do I therefore look into that and comment? So there the SA 720 itself tells inconsistencies if I have to report. But in normal situations, if there are any inconsistency, it is mostly clerical, so that they will anyway rectify. But if the information is not made available to you, then there are illustrations in SA 720 wherein it says that in case it is not made available to you, you will say that as and when it is made available to me, I will read it, and inconsistencies, if any, will be brought to those charged with governance. So that is the wordings change we have to imbibe in our audit report. Other information other than the financial statement and auditor's report thereon required even in the case of a private limited company. If this paragraph is not there, then I may consider it as a technical mistake when this matter refers to the Financial Reporting Review Board of the institute. Then management responsibility paragraph, then the auditor's responsibility, which we just now saw, which is normally given in the Annexure A, describing the assertions. Other matter paragraphs. What is this other matter paragraph? Other matter paragraph is a paragraph which you can have in your audit report to give any information related to audit. Let us say I have not audited a particular branch, or I have not audited in a consolidated financial statement a particular company I have not in Netherlands has been audited by a Netherlands based auditor. So then I will say in the consolidated financial statement, all audits I have done, or all audits in India has been done by Indian Chartered Accountants, but one company abroad which constitutes only 2% has not been audited at all. So something like that, if some matter related to audit has to be told, it will be covered under other matter paragraph as per SA 706. So report on other legal and regulatory requirement. We have already seen that today we are giving the 3 paragraphs through rules. And then CARO report, if applicable, that is another report that we give. Then 143.3 report, including the internal financial control report. So that's how I call it as a 4-in-1 report. So CARO and IFC, where it is not applicable, we have seen. Common mistakes in independent auditors report. What are the observations that the Financial Reporting Review Board has found out? Okay, I'll have to tell you, Financial Reporting Review Board was chaired by Babu Abraham Kaligal, and he has brought out a very good, what should I say, a book last year, a couple of years ago, which contains what are the normal, frequent non-compliances that have been found by the Financial Reporting Review Board during his chairmanship. Very, very good, useful book. I mean, I would suggest that all of you should read it. Graphically, they have showed which accounting standard has not been complied the most. And within each accounting standard, they are told which paragraph has not been complied the most. Now, when you read that book, you will come to know what type of mistakes we can avoid. I think that is the purpose of that. So thanks to Babu Abraham Kaligal and his team who has brought out this particular book. So common mistakes in independent auditors report. No addressing. I mean, normally, we have to say that to the members of so-and-so company. Address to the board. I mean, you cannot address an independent audit report to the board of directors. Reporting profit and loss account for year ending. When the financial statements are more than 12 months, you'll have to use the word period ending, and it cannot be year ending. Accounting standards for companies. The reference should be accounting standards as told in section 133 of the Companies Act, read with Rule 7 of the Companies Act. Companies Accounting Standard Rules 2006 is what the company's accounting standard application is about. You cannot say accounting standard issued by ICAI has been followed. ICAI accounting standards are applicable to non-corporate entities. For corporate entities, accounting standards of the company's accounting standard rules are applicable. Then every audit report should have a membership number and a firm registration number which is missing, which has to be dated. If it is not dated, it will be considered as a mistake. Place of signature is not given. Branch audit report has not been dealt with wherever there are branches. So finally, I will show you a 3-page notice which has come to a chartered accountant. Recently, they came to me to how to address this particular thing. You see how the various authorities are now targeting the chartered accountants. And let me tell you that there is something called a delivery gap, performance gap, if you may call, and something called an expectation gap. The chartered accountants, whatever I told you as far as the responsibility paragraph, I am responsible for what has been told in the responsibility paragraph. and in the standards on auditing. If there is some mistake with respect to that, then I would call it as a delivery gap from my side. But there are authorities who are expecting the moon from an auditor. They think that the auditor is the driver of the company. I mean, I am not the driver of the company. I am a policeman of the company. And I only police the company based on whatever information, sufficient, appropriate audit evidences that are made available to me and give my opinion. So there is something called the expectation gap, which you will see in the notice that is going to be read. Now, say the notice is something like this. It used to be a 40 pointer. I reduced it to 20 pointer for today. How the company contacted you? Look at this. The authority writing a letter to the chartered accountant. How did the company contact you? Do any of the partners of your firm know any of the directors or shareholders of the company? I mean, how do I answer this question? If I say yes, I mean, I cannot say obviously no. Without knowing the directors or shareholders, I cannot start the audit. So the answer has to be yes. So I'll have to say I know them, but not in a manner that they are related to me. I mean, not I'm anyway independent of. So that should be the message when I'm replying to this particular notice. Have you done any background verification of directors before accepting the assignment? So are you and I doing that? Is it required? Our institute has gone to the extent of having something called a KYC, know your client concept, just like the bankers have know your customer. I mean, in the banks, we sometimes used to say KYC is actually sometimes become kill your customer. When you are asking so much questions that you will go to some other bank. So you are killing the customer. So, but in this context, I think it is very important. And I would, therefore, whatever is given in black, I don't have any problem with that. So it is important for me, before a client comes to me, for me to know the client in detail, whether he is a PEP. I mean, today PEP is a very important concept called politically exposed persons. Like that, whether he's a person with a criminal background, what are the precautions that I have to take in case he's a PEP or a person like that. So those are the things which I have to do my job when I do the KYC. Directors, look at this, fourth one. Directors have given a statement that you are only managing the books of accounts of the company. Is it true? In that case, your firm is doing audit of the company and also managing the books of accounts of the company. It is against section 144 of the Companies Act. Kindly provide your explanation in this regard. Now you may be, I mean, some of you, if at all, are actually doing both. A warning for them, how will the other person come to know that I am writing the books of accounts and I am auditing it? Please be careful. The director or the accountant of the company or some other person in the company can write to anybody and they can come to know of it. That is point number one. Point number two, if you are raising a bill, then that itself definitely becomes an evidence. But in this context, be careful that a person who is writing the books of accounts cannot do the audit against the Code of Ethics, against section 144 of the Companies Act. Submit all audit working papers. Audit working papers, SA 230, audit evidence, audit working papers, very, very important. Please comply with that. And any of the regulatory authorities, if they ask it, we are bound to give them the audit working papers to show that audit has been carried out in the manner it was expected to be carried out. So please, I mean, therefore, peer review. Our institute conducts a peer review, and therefore we voluntarily sometimes say that you please come and do a peer review of our firm, so that today when the institute sends a chartered accountant, he will be a friendly peer reviewer. Tomorrow when the regulator asks for that, it will be a regulator with a gun. So please keep your audit working papers properly. Provide detailed working for revenue recognized. What kind of audit procedures you have conducted to assure that revenue recognized is true and fair? And why I said key audit matter, because in the case of this was a construction company, the revenue recognition itself is a key audit matter. Now, if you may say that it is a private limited company, that's why I said key audit matter, that is revenue recognition, inventory valuation, in the case of a construction company, is a key audit matter. It has to form a part of your audit documentation as to how you did it and what you did it and how you arrived at the final number, how you satisfied that everything was fine. But reporting of that particular key audit matter is applicable only for listed entities. Provide all balance confirmation you obtained from various parties. Now look at this. You cannot say it was his job to obtain the balance confirmation. In the case of true companies where you are doing an audit, you will have to. Now you may think, what is a true company? Whenever there are two parties, it is a true company. I mean, if it is a husband and wife and they are really attached, you don't know when they will be detached. So therefore, do your job properly. especially when there are two different groups, or especially when there are elected bodies, that much more responsibility on the auditor. Where the management and the owners are different, definitely high responsibility. In case there is any problem, these people will complain to the regulators, including the institute, and you will be a collateral damage. I use the word collateral damage because you are not the target. The target is somebody else, but if you are targeted, they will also become weak. So that is how they're trying to target the chartered accountant. So is obtaining balance confirmation the responsibility of the auditor? The answer is an yes. I will have to, my standards say that my sufficient appropriate audit evidence has to be taken. And this is exactly the case of Satyam, where the auditors failed to take the external evidence. They took the photocopies from the management and said the fixed deposit balance of 2,400 crores was okay, but when there were no fixed deposits. So it is responsibility of the auditor to obtain the external confirmations. Explain how you certified the closing inventory amounting to so and so. Did management of the company conduct any physical verification of inventory? Did you verify that report? If yes, provide the same. So please collect all this information. So I don't have any problem. This is what is required only, they have asked. How you verify that all related party transactions are on arm's length price? But in CARO, I have said that section 188 has been complied with. So against that, this question. So I just cannot say, yes, everything is okay. So therefore, I have to gather enough evidence to say that everything has been done properly. Have you checked that transactions between related parties are kept before the board of directors in the board meeting for approvals? How have you made sure the director's remuneration is paid only to whole-time directors? Now this is bordering between the auditor and the management. How do I know it? That means it has to be paid only to whole-time directors and managing directors and executive directors. So how do you have you made sure that the director's remuneration is paid only to whole-time directors? The point I'm saying is, if they're classified as whole-time directors, it is okay. But the point is, if they're just named as whole-time directors and are actually not whole-time working for the company, then it is beyond my job as an auditor. Now, this is a very serious allegation on the auditor here. As per audited financials for financial year so and so, you have certified that the revenue have been recognized as per accounting standard 9. But for construction companies, revenue should be recognized as per percentage of completion method AS7. Is there any specific reason for deviation from the applicable accounting standards? Now here we went into the records of the company. They have actually followed accounting standard 7, but in the revenue recognition, they have by mistake said that company is following accounting standard 9. So we are so bothered with the numbers that sometimes the words go beyond us. The disclosure maybe is given the least importance. So please give equal amount of importance to the disclosure also, and ensure that the disclosures are as per the accounting policy that you have actually used when you have done the accounting. Whether any suspected transfers happened in any financial year that came into your view while verifying the bank statements during the course of audit? If yes, why you did not disclose the same under emphasis of matter paragraph in the audit report? When this is going into, have you come across any fraud or suspected fraud? This is again expectation gap. I don't have to have a suspicion as an auditor. Only if I find out fraud, there is a requirement under 143(12) for me to report the particular fraud. I should never report the fraud under suspicion. So only if I have enough evidence, then I can shoot somebody as a fraud. But otherwise, I will be shot myself. So that's a point to be noted. Now, this point saying that if yes, why you did not disclose the same under emphasis of matter paragraph is not correct. I don't have to report it under emphasis of matter paragraph there. Did you conduct a physical verification of the site and ensure that the expenses reported in the audited financial statements are commensurate with the extent of the work completed? Very difficult. Last 5 points. Company has given loans to X, who is a shareholder of the company. Have you checked the reason for giving such a loan? This is what I call it as the expectation gap. I am not expected to check why they have given the loan. As long as I am giving the loan, that loan is given and it is shown in the financial statement. Whether the same has been given instead of dividend and to avoid DDT, beyond my role. Company has incurred advertisement expenses of so and so, so and so. Don't you feel this is very low as compared to the scale of the project? Now, I am not the CFO of the company to question the company. Just like in SA Builders case, income tax, we argue this. Income tax officer, the income tax officer cannot step into the shoes of the businessman. Just like that, auditor cannot step into the shoes of the businessman. Here I don't go to the question. I am only going to reflect the transactions in the financial statement, and if it is done, I consider it as true and fair. Beyond that, it is a CFO and whoever regulator you want to ask, you ask him. How did you assure that mobilization advances has been used only for business operations? Have you questioned that why, after being a construction company, that fixed asset register has got 7 luxury cars? And why audit has not conducted? Have you checked whether any personal expenses have been done? Okay, and then why audit has not been conducted after 15-16? Did you resign? In case of resignation, provide reasons for such resignation. So these are the type of notices that come in a session like this. We are so interested. So many people have joined to listen. And then when we work separately. But when a notice comes, it comes only to one person. So therefore, he is the one who has to face this. And to ensure that such a notice does not come, such a session is being conducted. So I always end up showing this one slide. As chartered accountants, we have to respect 3 important authorities or 3 important Vedas, I may call. I see Jai Prakash ji. I don't know whether I spoke to you. In Hyderabad, there is a chairman called Pankaj Trivedi. When I told him about this, I told him that what is Trivedi? Trivedi means, in Indian ethos, we have got 4 Vedas, and one who masters in 3 Vedas are called Trivedis. One who masters in all the 4 Vedas are called Chaturvedis, and one who masters in 2 Vedas are called Dvivedis. Okay, so in olden days, it was expected that a person has to know at least 1 Veda. Now, in chartered accountancy profession, we would say that 3 Vedas for us is the. So we will have to master these 3 things, and every chartered accountant has to be a Trivedi in that particular sense. So before I wind up, let me tell you one thing. Why is it, these questions keep asking, why is it that in spite of so many standards, accounting scams still happen? So the answer that I can tell for them is we are all policemen. And if in case of traffic rules, in spite of very good traffic rules, accidents happen. For that, don't blame the policeman. For that, don't blame even the traffic rules. As and when required, we'll have to amend the traffic rules. As and when required, we'll have to improve on the standards literature. But it is not the mistake of the literature itself or the mistake of the policeman or the auditor. It is the rash driver and a few auditors who are responsible for it. So therefore, if you feel that in spite of so many traffic rules and traffic lights, accidents happen, then remove the traffic rules. Then you will see that every place there will be an accident. Like that, in spite of so many standards, if accounting scams still happen and somebody feels remove audit, remove standards, then you will see that every financial statement will be a scam. So with that, I conclude my session, taking exactly 20 minutes more than the last. But I can only say that I am proud to be a chartered accountant. Now let's follow all the standards and also be a standard accountant in the process. Thank you so much.
Thank you very much, sir. And we all are proud only because we have got an excellent faculty, Gururaj Acharya, sir. And sir, it was an excellent session, seamless 2-hour session, and you have traveled through all the companies that we private limited company. You have traveled through Caro, you have traveled through CAM, you have traveled through going concern aspects, and it is definitely a combo session, sir. Absolutely great, and it's a great loss for those who could not attend, whatever may be the reason. And I think that this 20 minutes is not enough to accommodate you. And I'm sure that if you are getting another chance, and we will definitely compensate that particular time. Sure, sir. Sure. German, sir, anything has to be added?
I just want to say that he traveled through everything without traveling to Kerala. What more? We cannot be very passive about what we are doing. The surveillance lens is on us, on the profession, individually and collectively also. We have no regulators, so we have to be more careful. And whether it is accounting standards, statement standards and auditing, code of ethics, all that, we should adhere to the best possible practices. Only then that the profession will remain relevant and the status of our profession will remain as in the desired levels. Failing which, corporate failures, in that audit failures are all casting a shadow on the reputation of the profession, which will have a very, very adverse impact on the profession individually and collectively. And in the COVID times, we have to be very careful. There are 5 COVID pronouncements of ICAI which have to be referred and applied. Emphasis on matter paragraph, particularly going concern, which conventionally accounting assumption cannot be an accounting assumption in the given circumstance of uncertainties. One has to be very careful there. So that's it from my side. Wonderful session, sir. Thank you so much. Manoj sir had, after 20 minutes into the session, Manoj sir had called me and said, Jomon, this is Manoj. Manoj is a very common name in Kerala. I said, Manoj, which Manoj? Jomon, Manoj Fatnis. Oh my God, sir, I'm sorry. And then he said, nice session, but he had some other meeting. So he took kind of a concern and left. So it was wonderful, valuable inputs, intellectual remarks were very good. Nice to see all the chairmen glowing, and past chairman also, Saju, Kattu, Shilpa, who got Best Branch Award, and Ms. Sakasa to Chor. And then the originator. Originator is a big then who else is there? All are there. So Shivprasad sir, how are things? What things for you? You and your background looking very colorful.
Sir. Yeah, what is to be done if the previous auditor does not issue an NOC? He doesn't respond at all. Very clear that an auditor's responsibility is to communicate with the previous auditor. It is not in any sense called a NOC. While it is, I would respect every chartered accountant in case there is a letter for change which has come, and if it is a genuine change, please give your opinion, NOC or whatever you have to say. But the person who is taking up the audit need not wait for the NOC of the other person. If let us say 7 days to 10 days time, if it does not respond, then as long as you have the proof of giving that particular request for from communication to the previous auditor, that should be sufficient. Even if it does not respond, you can consider it as a passive NOC. Can a private limited company bring in share capital in cash or in kind? Yeah, it can bring it in cash or in kind. There is no restriction for that. If it is brought in kind, then you will have to file an additional form to say bring in a valuation to say why it was brought in kind and whether that is properly accounted. It can bring it in non-cash consideration also. For companies severely affected by pandemic, such as in hospital, is an emphasis on going concern warranted in the audit report. And I would say that if the going concern issue is actually there, you can definitely bring in. And let me tell you, if the going concern is actually impacted by bringing in just a paragraph, it would not help. You will have to, if the company is actually going to be wound up or eventually going to be closed up, you will have to, the fundamental accounting assumption of going concern is gone. So therefore, you will have to bring it on realization and payable basis and draft your financial statements accordingly. However, if you feel that the company has uncertainty, but it will eventually, like a phoenix, rise to the occasion, you will have to take as an auditor sufficient documents to find out why it will go out as a phoenix to rise through the occasion. The promoters are strong and things like that. And then you can give it as a going concern, material uncertainty with respect to going concern, bring out this pandemic issue as a going concern issue, and how they are going to mitigate that. You can bring in. The other question that came out is whether I need to file MCT 14 for appointment of full-time directors made in an AGM. The answer is no. I told you, resolutions passed by the board of directors alone with respect to managing director's appointment, that needs to come. So loan from members received prior to 1415 can be retained even still now. The answer is no. And if there is a deposit which was exempted in 1956 Act, which continued with you, there was a period up to which you could have taken it free. Afterwards, there was no automatic grandfathering. You have to repay it, or consider it as a red deposit. Let me be very clear. So there is no grandfathering possible. So I think these are all the smaller questions, but then there are certain other bigger questions which I would like to avoid, in the sense deadlock will come in account of disqualification and he is refusing to resign. So there are certain issues which become very litigating, which I don't want to take at this point in time. But otherwise, we have covered it. Yes, sir.
Sir. Thank you so much, sir. Back to JP.
Yes, sir.
memento. Sir, could you please explain that? Show that virtual memento.
Yeah. Virtual memento is ready. Office will virtually hand it over to you now. And then, that is photograph closer. Can you bring it closer to the screen?
Yeah,
Sir, it is proof that you have been part of the Navaratna with your photograph in session.
fantastic.
Shino, can you push it forward a little bit? Bring it closer to the screen.
No, I could see that. Yes.
Okay.
Fine. That's done.
Thank you. Yeah. Okay. So anyway, thank you once again, and really you are a guru and Raja and Acharya. And to conclude, I am requesting my secretary C.S. Shivaprasad sir to propose vote of thanks.
Chairman of today's seminar, illustrious past president of the Institute of Chartered Accountants of India, Chartered Accountant Manoj Patis, very distinguished learner speaker, Chartered Accountant Gururaj Acharya, the conference chairman, esteemed Central Council member, Chartered Accountant Babu Abraham Kallivailil, convener and the immediate past chairman of SIRC of ICAI, Chartered Accountant K. George, and very dynamic chairman of 9 ICAI branches of Kerala, my dear members in the profession. It is our great honor and extreme privilege to have the past president of ICAI, Chartered Accountant Manoj Patis, who led our profession in the year 2015-16 as the chairman of today's session of Navaratna. We place on record our sincere gratitude to him. It is no doubt that we have got the right person for presenting the paper on audit and exemptions for private limited companies. We are fortunate of having Chartered Accountant Gururaj Acharya for leading the discussion, and he presented the paper extremely well. We can say simply super. We are grateful for sharing his knowledge and for his excellent presentation and the address. Thank you very much, sir. Thank you. It is an outstanding idea of joining 9 branches of Kerala together and having 9 days program named Navaratna, All Kerala Virtual CPE Conference. And the participation shows that it is well acclaimed by our professional fraternity. We are really indebted to our leaders, the Central Council member, Chartered Accountant Babu Abraham Kallivailil, and the past chairman of SIRC, Chartered Accountant Jomon K. George, who have taken the lead role, and all the chairmen of 9 branches. It is well designed and well organized. Our sincere thanks to all the leaders who have taken this initiative. Thank you. We are very much thankful to all the participants, members for the support, motivation, and for the gracious presence. See you all tomorrow afternoon for another excellent seminar. Thank you.